Right, so last week on the 22nd and 23rd of May, I said that there was a high chance the market was due for a rally, due for a bounce because of a couple of things, right? So we said that the market was extremely oversold and the market's like a rubber band or like a pendulum. Once it gets oversold, it tends to snap back up, right? So last week I said that if you take a look at the S&P, the NASDAQ, it was way oversold. For example, if you take a look at the triple Q, the NASDAQ ETF, we said it has dropped so much that the Williams percentage R is in oversold territory. And this is on the weekly candles. And this doesn't happen that often, right? This happened back here at the bottom of the COVID crash. It happened here at the bottom of the 2018 correction as well, and it's appearing again here. So it tells you that the market on a long-term basis very oversold, due for a bounce. At the same time, I said, hey, the last two times the NASDAQ went down, it bounced off that 150 moving average, that green line, and it's testing that level right now. So there's a high chance it's going to bounce back up. I also mentioned in my video that for the very first time I saw divergence between the S&P going down and the advance and decline line that was actually going up. And it's the first time that it happened in a long time. So, I talked about the S&P making lower lows, lower lows, lower lows, lower lows. And generally the advance decline line makes lower lows as well, which means there are more decliners than advances, more stocks going down than stocks going up. But for the first time, we saw the S&P making a lower low, but the advanced decline line making a higher low. So that's divergence. So that means that the market on the whole looks like it's going down, but there are actually more stocks going up than going down within the S&P. So that was a very interesting thing that just happened. And I said these are signs that the market is beginning to show signs of a reversal. So sure enough, we got that bounce we were waiting for. We got that strong reversal rally. And you can see that last week we ended with a very bullish candlestick pattern. After 7 red candles in a row, we had one big white candle that appeared. So this is a very powerful bullish signal. This is a sign that the market has bottomed, at least for now. So for the next couple of days at least, I expect the market to continue going up. So I'm very bullish on the short term, which I mentioned the last time. You can take some short-term bullish trades in the market. Now let's zoom down and take a look on the daily candles. So on the daily candles, you can see that we bottom right here. And I mentioned in my last video, this is known as a classic bear trap, where the market goes down and people think that, hey, we're in a bear market, and they all go short. And the next thing the market does is it reverses back up and traps all the bears, goes up, and the bears get killed. We call that a bear trap. And that signaled the bottom of this correction. So since then, we have had 1, 2, 3, 4, 5 days of very bullish action. And we have broken above this short-term resistance level. All right, so you can see this was a resistance. Resistance. We broke above that resistance. And that's why we are short-term very bullish right now. Now over here, you can see that I actually caught the market bottom a few times, if you recall, right? So I said, hey, this could be the bottom. It went up and reversed back down again. And I said, hey, this could be the bottom. It went up, reversed back down again. So this was a previous resistance that it broke above, and then it came back down again. So here's the point. You know what? I can tell you when the market is going to reverse. It's very simple. Just look at the candlestick patterns, look at oversold levels. What I can't tell you with a crystal ball is how long this rally will last. I can't tell you that. It's kind of like the ancient one, right? I can't see beyond a certain point. I can tell you that it's going up, but will it continue? I can't see that because there are too many variables in play that I can't predict. For example, I can't predict the earnings of companies. I can't predict whether the 10-year yield is going to continue going down or going up. And I'll talk about that in a while. But for now, like I said, we are bullish. We are going up. But question is, is this the bottom of the year? And are we going to go to all-time highs, or is this a dead cat bounce again? Are we just setting up for another leg down? Now, if you listen to most comments on social media, and you listen to most people on the financial news and on YouTube, the majority of people believe that this is a dead cat bounce, that this is a bear market rally. So what does that mean? That means the majority of people believe that, you know what, don't trust this because you've got a wave down, a wave up, a wave down. So what they're saying is that it's going to wave up, it's going to hit a certain level, and boom, we're going to go all the way down even lower. So is this possible? Could this be the start of an even bigger bear market? I don't know. And here's the interesting thing that I've learned over the last 30 years of being in the markets. When most people expect something, it doesn't happen. Right? That's just the way the market is. And when everyone expects a recession, when everyone expects a big bear market, sometimes it doesn't happen because the market likes to, tend to go opposite of what the majority think. It's just the way it is. In fact, there's an old saying that says the market tends to move in a way that hurts as many people as possible. And that's why if most people think that it's a bear market rally and most people get ready to go short, the market tends to fake everyone out, goes the opposite direction and hurt as many people as possible. So for me, I'm keeping an open mind. I believe that anything can happen depending on the data that we get, whether companies continue to report earnings that grow or decline. But for now, my base case is that I don't see this as a bear market rally. I don't see it until I get, again, different evidence. And I'll explain why in a short while. So what's happening right now is I'm looking at the market and saying, okay, short term, we are going up. We're really bullish, right? However, we're going to face some resistance that could turn it back down. So what are the levels that I'm looking at? So that's the first question. So the first level I'm looking at would be this. Now, again, bear in mind that I'm using some technical patterns. So one of them would be Fibonacci. So again, if you see this as a wave down, a wave up, a wave down, and now it's on a wave up, right? So where's this wave up going to end? So usually it would reverse at a Fibonacci level, all right? So it could be the 50% Fibonacci level or the 61.8% Fibonacci level. So I'm going to watch these two levels very carefully to see will the market reverse at these levels. If it doesn't, it keeps going up, then great, right? But if it reverses, I may put in some short hedges by going short on the market using options where I'm still holding my long-term investments. In the long term, they're going to go up. But in the short term, I may short the market with bear put spreads, depending on the price action I see at these levels, right? So you're going to watch this level at 4226 on the S&P and 4324. Now, if you can break above these two levels, then we're kind of like almost home free, right? But wait, there is another significant resistance here. If I were to draw this point to this point, then it will be somewhere here at, let's see, at about, let me just draw this over here, somewhere about 4479, right? Oops. Let me just draw that with a different tool. Okay. About that. Okay, 447. Okay, 4477. Okay. So this could be a significant level as well, right? It could go up and it could reverse back down. So again, if you can break above this level 1, above this level 2, and break above this level 3, then we could have a very strong push all the way back to new all-time highs, all right? And that's why I keep saying that as an investor, do I want to wait for a confirmed new uptrend or rather a confirmed all-time high to start buying stocks? No, because by the time that happens, stocks are going to be expensive again. And that's why I've already been buying. I have already been buying stocks consistently in the last couple of weeks because I know that in the long run, good companies will always go up. So whether it goes up now or goes up next year, it's really immaterial to me, all right? As far as short-term trading is concerned, I could take some quick short-term trades, but when it reaches this resistance level, I may want to take profit on my short-term swing trades. Now, let me just say that unlike many people who are already convinced, who already believe we're in a bear market, it's going to be a bear market, really, we're going to die, I'm not in that camp. So my base case is I look at the facts. I don't just go blindly into believing something. And the facts say that we are not in a bear market, at least not yet. And this is not a bear market rally, at least not yet. Why? Remember, a bear market is defined as when the S&P closes 20% below the high, which is this level over here. Did we close 20% below the high? Nope, we did not. We flirted with that level. So you can see S&P almost went to 20%, came back up. Then went below 20%, flirted with the level, trapped the bears, but closed back up. So it never closed below 20%. So this ain't a bear market. At least not yet, right? And this is not a bear market rally if it's not a bear market. Now, what would cause the market to really go into a bear market? Well, what has to happen is that companies' earnings will have to decline. Now, a lot of people are saying that the market today is going to be like the year 2000 .com crash or the 2008 financial crisis. You can't say that until the facts prove otherwise. Because remember that during those two bear market recessions, what happened to corporate earnings? These are operating earnings per share. They went negative. As you can see, this was back in the .com crash. Operating earnings went negative. Same thing with the financial crisis, operating earnings went negative. Same thing with the 2020 recession, earnings went negative. So as of right now, are operating earnings negative? Not yet. Could it? Maybe, but not yet. So until it happens, we should not jump the gun. So currently, operating earnings of the S&P 500, they are still positive. They're still growing, although they're slowing down, but they're still growing. So is it a possibility that we could go into recession and hence company earnings start to go negative? Well, again, everything is possible, but for now, there's no data that proves that, right? So until the data proves otherwise, we should not jump the gun. So if you take a look at the latest, now this is the latest estimates data from the Atlanta Federal Reserve. And you can see the latest shows that GDP is still projected to grow in the second quarter of this year. As you can see, 27 May advanced economic indicators show a 1.9% projected GDP growth based on all these variables like equipment, non-residential structures, residential investments, governments, exports, imports, and so on and so forth, right? So for now, no bear market yet. Doesn't look like financial crisis, .com crash. Companies are still making money. Earnings are still growing. Now, what's also interesting to note is that this strong rally in the market is not only due to technical oversold factors. It's not just emotional, but there's actually a fundamental shift in the macro picture. What's been happening? Inflation has actually been coming down. The 10-year yield has actually been coming down. And you find that for the first time, Bitcoin and cryptocurrencies are not correlated with the market. So these are very, very powerful developments and shows a shift in what's happening beneath the surface of the markets. Now recall what I said a couple of days ago. In fact, I have said many times that based on the research done by Larry Williams, that we are near to the peak in inflation. Based on the inflation cycle forecast, we are coming to that peak, which is somewhere in June, which is where we are at right now. And the moment inflation peaks and comes down, what tends to happen? It tends to coincide with market bottoms, right? Showed you this before, that every time the market, or rather inflation, the black line peaks, comes down, that's the market bottom. Every time inflation peaks, comes down, that's the market bottom. Every time inflation peaks, comes down, that's the market bottom. So inflation peaking and coming down is one of the best signals to enter the market. There we go again. Inflation peaks, comes down, market bottom. Inflation peaks, comes down, market bottom. Inflation peaks, comes down, market bottoms. So has inflation peaked? Well, looks like it may have already peaked. Again, there are no guarantees it could go up again, who knows? But for now, it looks like inflation may have peaked. Why? For the first time in several quarters, it looks like consumer inflation measured by CPI, core CPI, PCE, whatever measure, it shows that it's actually been abating. Inflation is coming down for the first time in many, many quarters. So that's a very, very bullish sign for the markets, and that's why the markets rallied so strongly as well, not just because it was oversold. So what has caused inflation to start coming down? Well, number one has been the easing of supply chain restrictions from China as they start to find that, okay, they are getting COVID under control, they are reducing the lockdowns. Number two would be the demand destruction from higher prices anyway. So now with higher prices, higher gas prices, higher property prices, people are starting to cut back on their spending, lowering their demand, and that is causing inflation to come down, which is a good thing, which is what the Fed wants anyway. And for the first time, companies like Target and Walmart that got whacked, they reported excess inventory. So when companies show that we have got excess inventory, that means we couldn't sell as fast as we want. It shows that inflation could have peaked. Next, we are also getting news from companies like Microsoft and Amazon and Nvidia that for the first time they're saying, you know what, we're slowing our hiring. In fact, we're freezing our hiring and even cutting staff. So that shows that this is gonna temper or bring down some of the wage-based inflation pressures, which is the rise in wages is coming down as the labor market gets less tight. And that's what the Fed wants to see. Once we see inflation kind of like getting subdued, the 10-year yield comes down, the market's going to rally really, really strongly as well. The next thing that you can look at is what is known as the 5-year and 10-year break-even inflation rate. So what does it mean? The 10-year break-even inflation rate measures what the market thinks inflation will be in the next 10 years. It's their expectations of long-term inflation. And you can see that the one in blue, right? It went all the way to 3%. And since then, it has actually come down to 2.6%. The 5-year break-even inflation rate has also come down quite a bit. So all signs are pointing that inflation is abating. Now, you can also see this in the 10-year Treasury yield, which I mentioned that it is at a very strong historical level of resistance. And for the first time, we actually closed or are going to close with a bearish monthly candle on the 10-year Treasury yield. So high chance the 10-year Treasury yield has kind of like peaked and it may be coming down. So remember that the 10-year Treasury yield is kind of like a proxy for inflation. When a 10-year yield goes up, people expect more inflation. Excuse me, when a 10-year yield comes down, people expect inflation to come back down, which is very, very bullish for the markets. If you take a look on the daily candles, on a daily time frame, and again, if I were to superimpose that on the S&P 500, you can see how that plays out, right? So when the 10-year yield started spiking up, right, S&P started selling off. So now it looks like as 10-year yield begins to come back down, hopefully stay down, the market will have a chance to rally back up again. So I'm going to watch the 10-year yield very closely. I mean, of course, the 10-year yield can go up again and that may pull the market back down again. Anything could happen, so I'm watching this 10-year yield. So the majority of people out there are giving all kinds of reasons to be bearish. Maybe they're right, I don't know, right? But I'm going to give you reasons why I'm bullish, reasons to be bullish. And the first reason is because, like I said, the S&P 500 is not yet in a bear market. It's still in a bull market. It's still in a correction in a bull market. Now, at the same time, after this correction that we have had in the last 5 to 6 months, the market is no longer expensive. In fact, the market is now generally undervalued based on the price-earnings ratio of the S&P 500. And you can see that the 10-year average PE ratio is about 20 times earnings. And the 5-year average PE ratio is about 23 times earnings. Currently, after the sell-off, we are at roughly about 18 times earnings. So we are actually undervalued on a PE ratio basis. So in other words, the market's not expensive anymore. The market is generally cheap. And you know that within the market, there are many good businesses that are really undervalued by 20, 30, 40%. And that's why I've been consistently buying shares in this market. So even if it goes a bit lower, I don't really care. As long as you buy good companies that are undervalued, you've done your job. You don't have to predict exactly when the market is going to go up, could go up this year or next year. It doesn't matter because over time, You buy good companies cheap, you will make money. It's impossible to lose money, right? If you buy a portfolio of great companies. So based on this knowledge, what's the strategy for an investor? So I'm going to talk about from an investment perspective first, and then from a short-term swing trading perspective. So first, from an investment perspective, is this a good time to buy shares of good companies? The answer to me, in my opinion, is yes. In fact, I've already been buying shares consistently for the last couple of weeks. Remember, as long as you buy shares of good businesses and you buy them when they're undervalued, you will make money over time. The companies will compound and grow in value. So the important thing is to ensure that only buy companies that are profitable, that have got positive free cash flow, that have got competitive, durable advantages, that have got conservative debt. So if you are holding trash companies that are not making money, that are overpriced, that are speculative hype companies, then to me, if I'm holding those crap companies, I'll use any rally in the markets to get out of those stocks, to get out and take the money and to reallocate to good companies. And again, if you don't know how to identify or analyze if it's a good company, you got to take the value momentum investing course, because that's how we teach you how to only buy good companies. So if you buy good companies at a discount, you can't lose money. It's impossible to lose money if you're patient. You buy a portfolio of good companies, they will rise over time. And like I said, you don't have to buy at the exact bottom. As long as you buy when it's undervalued, you've done your job as an investor. So I continue to like I said, been buying in the last couple of weeks, and I continue to buy right now of those great companies. Now, from a trading perspective, it is different, right? In trading, it's a one-night stand. You just go in, go out, got your stop loss, your profit target, and you don't really care about valuations. You don't care about good company, just trading based on the price action. So from a trading perspective, I would say that one could take some short-term long trades cautiously, because right now short-term the market is bullish, so I expect the market to be bullish at least for the next couple of days. So you could take some quick swing trades to get in the market and to take profit quickly once it hits certain levels of resistance. And once those resistance are hit, if you see a reversal pattern, you could take some short trades as well by using options, bear put spreads on the S&P, ETF, or the triple Qs. So that's from a trading perspective. All right, so hope that helps, and may the markets be with you. Let's see how it unfolds for the rest of the year. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.